Hi everyone, welcome back to Economics per se. Today we will continue with topic 1 of chapter 2, which is national income. Last week we stopped after we studied about the marginal product of labor. This week we will continue with the marginal product of capital, the MPK, and capital demand. We'll then look at the division of national income. We'll look briefly at the Cobb-Douglas function, and then we'll see what determines the demand of goods and services. And we'll end the topic next week with an in-depth look at equilibrium in various markets. Let's start with the marginal product of capital, the MPK. Just like MPL is the amount of extra output from hiring an extra unit of labor, holding capital constant, the MPK is the extra output that a firm gets from hiring one extra unit of capital, holding labor constant. So writing it down, MPK is equal to f of k plus 1 L minus f of k L. And now, just like we saw with MPL, the change in profit for the firm because of change in capital can be found with this. The change in profit is equal to the change in revenue minus the change in cost. The change in revenue here will be generated because of the MPK. So price times MPK will determine the change in revenue, minus the change in cost here is only the price of the capital, because only capital is changing. The price of capital is rent. So to maximize profit, the firm continues to rent more capital till MPK falls to equal the real rental price. What is the real rental price? Just like wage over price is the real wage, rent over price is the real rental price of capital. So MPK would equal to rent over price. Rent over price. The real rental price is the rental price measured in units of goods rather than in dollars, just like MPL was measured in goods rather than in dollars. So to sum up, the competitive firm with the goal of profit maximization follows a simple rule about how much labor to hire and how much capital to rent. The firm demands each factor of production, labor and capital, until the factor's marginal product falls to equal its real factor price, which are the real wage and the real rental price. With formulas, you can say a firm will hire till MPK is equal to rent over price and MPL is equal to wage over price. Great. Now let's see how the national income is divided. Since we now know how a firm decides how much of each factor to employ, we can explain how the markets distribute the economy's total income. Well, if the firms were competitive and profit maximizing, then each factor of production is paid its marginal contribution to the production process. That is, real wage will be paid to each worker, and the real rental price of capital will be the MPK. The total real wages paid to labor is therefore, MPL times L, and the total real rental price paid for capital would be MPK times K. Now, the total that remains after the firms have paid the factors of production is the economic profit of the firms. The economic profit is equal to output Y minus the payments made to labor, which is MPL times L, minus the payment made for capital, MPK times K. But since we want to examine the distribution of national income, we rearrange these terms as taking these to the other side. Y is equal to economic profit plus MPL times L plus MPK times K. So the total income is divided into returns to labor and return to capital and the economic profit. But now there's another question. How large is the economic profit? A lot of people don't like this answer, but if the production function has the property of constant returns to scale, remember we discussed this in chapter 1, then the economic profit must be zero, meaning that nothing is left after the factors of production are paid. This comes from Euler's theorem, a famous mathematical result which will be discussed in our videos for mathematical economics in the future. The theorem suggests that if there are constant returns to scale, then f of k L would equal to mpk times k plus mpl times L. So in other words, if the firm is competitive and profit maximizing, then there exists constant returns to scale and economic profit is zero. But you may ask, how can a business sustain itself with zero profits? The term profit as normally used is different from economic profit. We've been assuming that there are three agents: workers, owners of capital, and owners of firms. But in the real world, most firms own their own capital. Because firm owners and capital owners are the same, economic profit and returns to capital are lumped together. Let's call this accounting profit. So, accounting profit is equal to economic profit plus MPK times K. Therefore, you can see that under our assumption of competition, profit maximization, and constant returns to scale, economic profit is zero because profit in the national income is mostly returns to capital. Now, we can answer the question, how is income of the economy distributed from firms to households? Total income is total output of the economy, which is divided between the payments of capital, payments to capital, and payments to labor, depending on their marginal productivities. Let me now tell you a quick story. In 1927, Professor Paul Douglas, who later became a US Senator, observed that as the economy grew over time, the total income of workers and the total income of capital owners grew at almost the same rate. Professor Douglas wondered, what leads to constant factor shares? He then asked Charles Cobb, a mathematician, if any production function would produce constant factor shares if factors always earn their marginal products. So the function would need the properties that capital income would be equal to MPK times K, which would be equal to alpha y being output. And I'll tell you what alpha is in a second. And we would also need the property that labor income would be equal to MPL times L, which would be equal to 1 minus alpha y, where alpha here is a constant between 0 and 1 that measures the capital's share of income. This would mean that alpha would determine the share of income to capital and to labor. Cobb then showed that the function with such a property would look something like this. K to the power alpha, L to the power 1 minus alpha, where A here is a parameter greater than 0 that measures the productivity of the technology available at that time. This is what came to be known as the Cobb-Douglas production function. Now, let's take a closer look at this function. The Cobb-Douglas production function has constant returns to scale. That is, if capital and labor are increased by the same proportion, then output increases by that same proportion as well. Let's see what happens when we multiply capital and labor by a constant C. So f of zk zl is equal to our A, technology, Z k to the power alpha, and zl 1 minus alpha. Now let's expand it here. A z to the power alpha, k to the power alpha, c 1 minus alpha, l 1 minus alpha. We know that z to the power alpha times c to the power 1 minus alpha is equal to z. So that means k to the power alpha 1 minus alpha. I hope you're following. After here, we know that a k to the power alpha l 1 to the power n to the power 1 minus alpha is equal to our production function, our output. So f of ck zl is equal to z f to the power ck, f to the power k and l, which is equal to c to the power 1. By this, we can see that the amount of output y increases by c when both capital and labor are increased by c, proving constant returns to scale. So now that we know that the Cobb-Douglas production function gives us constant returns to scale, we have to consider the marginal products for the Cobb-Douglas production function. Here, we're going to have to do a little bit of basic derivatives. Now we have the production function. F of k and l is equal to a k to the power alpha l to the power 1 minus alpha. We're going to have to derive with respect to l. So f of kl prime is going to equal, taking this to the front, 1 minus alpha a k to the power alpha l 1 minus alpha minus 1. So this would mean that this is the MPL, which would equal to 1 minus alpha a k to the power alpha l negative alpha, because these two go out. Similarly, the change in output with respect to change in capital would give us the MPK. So for the MPK, it's almost exactly the same thing. We're deriving with respect to capital now. So alpha, a, capital, alpha minus 1, L 1 minus alpha. And this is the MPK. Okay. From here, we can see that an increase in the amount of labor reduces MPL and increases MPK, and an increase in capital increases MPL and decreases MPK. Well, awesome. Now with that out of the way, we can look at what determines the demand for goods and services. Now, I hope you remember our identity, national accounts identity we did in chapter 1, which states that y is equal to c plus I plus g plus nx. Because we're now going to have to dissect each one of them. Well, except nx, net exports, because we're still assuming that we're looking at a closed economy. From our identity, we can say that the households consume some of the economy's output, firms and households use some of the output for investments, and the government buys some of the output for public use, just like we did in our circular flow diagram. So, number 1, C for consumption. I know you know what consumption is, because whatever we do, we're consuming something that the economy has produced. Households receive income from work, and then they pay taxes. After taxes, they decide how much to save and how much to consume. At the aggregate, we know that total income is the output of the economy, which is Y. But the government then takes taxes, an amount, T, from Y. Let's say that. For now, we'll lump every kind of taxes in this T. After paying taxes, Y minus T, the households are left with disposable income. And this is disposable income. Again, disposable income is just income minus taxes. We assume that consumption depends directly on the amount of disposable income. That is, higher the disposable income, higher the level of consumption. So the consumption function would be C is equal to C of Y minus T. This is called the consumption function, and it states that consumption is a function of disposable income. That's it. From this, we get the marginal propensity to consume, though, the MPC, which is the amount by which consumption changes when disposable income increases by $1. The MPC is between 0 and 1, meaning that an extra dollar of income increases consumption, but by less than $1. Let me show it in a graph quickly. Hypothetically, this is our graph, consumption right here, and then we have disposable income right here, and the curve would be something like this, and the slope would be equal to MPC. Higher the disposable income, higher the consumption. That's it. Now, the second part of our identity up here is investment. Investment. Both firms and households purchase investment goods, but the quantity of investment goods demanded depends on the interest rate. The interest rate measures the cost of the funds used to finance investment. If the interest rate rises, fewer investment projects will be profitable and the quantity of investment goods demanded will fall. Imagine you are the owner of a firm and you're considering if you should buy or build, let's say build a $2 million factory that would give a return of about $200,000 per year, or around 10%. You'll compare this return with the cost of borrowing that $2 million. If the interest rate is below 10%, you can borrow that money from the financial markets and still expect to make a profit. If the interest rate is above 10%, you're better off not building that factory. When discussing interest rates, it's really important to distinguish between real and nominal interest rates. The nominal interest rate is the rate of interest that investors pay to borrow money. The real interest rate, however, is the nominal interest rate adjusted for inflation. If the nominal interest rate is 10% and inflation is 5%, then the real interest rate is 5%. In sum, we can say that investment is a function of real interest rate, meaning that I is equal to I of R. The real interest rate is negatively related to the quantity of investment demanded. So in a graph, if this is investment and this is the real interest rate, the curve would look something like this, and this curve would represent the investment function. That's it. And now, lastly, because we are assuming it's a closed economy, number 3 is government expenses. We know that governments spend a lot of money for the benefit of the public. New roads, new buildings, wages for government officials, and there's so many other examples. But this is just one kind of expense the governments incur. Governments also make transfer payments such as welfare and social security payments. However, these are not included in the GDP because they are not payments for a service or a good. We discussed this in chapter 1 if you remember. Although transfer payments are not included in the GDP, they do affect the demand for goods and services because they increase a household's disposable income. Transfer payments act exactly in the opposite way as taxes do. So if transfer payments are financed by an increase in taxes, disposable income will remain unchanged. With this in mind, we now have to change our definition of taxes. Taxes, which we call to be T, will now be equal to the taxes minus transfer payments. it's going to have to be taxes minus transfer payments. Now, disposable income, y minus t, incorporates both the good effects of transfer payments and the negative effects of taxes. Let's speak a little about the budget here. If government purchase equals taxes minus transfers, this t, I'm saying that if G is equal to T, then we say that there's a balanced budget. If government expenses are more than what they collect, we have a budget deficit. And we'll look at what the government does when they have a budget deficit. And lastly, if the government expenses are less than what they collect, we have a budget surplus. Here, for now, we will take government purchases and taxes as exogenous variables and won't look into how the governments come up with them. To represent them as variables fixed outside our model, we will denote them with G bar and T bar for now. Okay, so now that we know what determines the supply and the demand of goods and services, in the next video, which will be the last for this topic, we will look at the main picture of what brings the supply and demand for goods and services into equilibrium. We'll also look at equilibrium in the financial markets of loanable funds, and we will see certain effects of fiscal policy on the economy. I can't wait to see you guys then. If you like this video, please give it a thumbs up, and I'll see you again next